This annual event is critical as it is an opportunity for us at the Central Bank to interact with major players and the business communities and share our perspectives on the burning issues affecting the banking and financial services sector and the economy in general. Importantly, it avails key industry operators a platform to gain knowledge of regulators' views on the underlying factors driving the state of our economy, the policy focus that will shape macroeconomic and financial market conditions, and our understanding of the short to medium-term outlook of the economy. Distinguished ladies and gentlemen, the global economy, much like our domestic economy, often experiences cyclical patterns. The recent Russia-Ukraine conflict, coupled with the ongoing disruptions caused by the COVID-19 pandemic, has had severe consequences for global supply chains, particularly in agriculture and energy sectors. These disruptions have resulted in a significant decline in commodity prices and international trade. The sustained high crude oil prices exceeding $80 per barrel have posed challenges for import-dependent countries like Nigeria in managing prices. The prospects of the global economic recovery have been further dampened by the ongoing crisis between Israel and Hamas. The International Monetary Fund, IMF, warns that these conflicts have serious implications for global economic performance and leave little room for policy errors. In response to the inflationary pressures caused by the surge in energy prices resulting from the Russia-Ukraine conflict, monetary authorities worldwide have raised policy interest rates, leading to tighter global financial market conditions and significant outflows of funds from emerging market countries. These developments have led to a strengthening of the US dollar, exacerbating inflationary pressures while weakening currencies and depleting external reserves in many emerging market countries. As a result, several central banks in emerging markets and developing economies have implemented restrictive policies to contain rising inflation and reduce capital outflows. The widespread tightening of monetary policy aimed at curbing inflation has restrained economic activity and suppressed growth. According to the IMF, global growth is projected to slow from 3.5% in 2022 to 3% in 2023 and 2.9% in 2024, well below the historical average of 3.8%. Advanced economies are expected to experience a slowdown from 2.6% in 2022 to 1.5% in 2023 and 1.4% in 2024 as the impact of policy tightening takes hold. Meanwhile, emerging markets and developing economies are projected to have a modest decline in growth from 4.1% in 2022 to 4% in both 2023 and 2024. Global inflation is forecasted to steadily decline from 8.7% in 2022 to 6.9% in 2023 and 5.8% in 2024, thanks to tighter monetary policy measures and lower international commodity prices. However, core inflation is expected to decline more gradually, and inflation is not anticipated to return to target levels until 2025 in most cases. It is crucial to note that monetary policy actions and frameworks play a vital role in anchoring inflation expectations during these challenging times. In response to these challenges, countries worldwide have adopted various conventional monetary policy measures. Available data indicates a gradual recovery in output in the US, UK, and some emerging market economies. GDP growth in the US, UK, and emerging market economies reached 2.2%, 1.4%, and 3.4% respectively in the second quarter of 2023 compared to the same period in 2022. In Africa, on the other hand, countries such as South Africa, Ghana, Egypt, and Kenya saw growth rates of 0.6%, 3.2%, 3.9%, and 5.4% respectively in the second quarter of 2023, thanks to complementary fiscal and monetary policy measures. Considering these developments, it is evident that economic fundamentals play a crucial role in the effectiveness of monetary policy actions in addressing macroeconomic challenges. Therefore, it is imperative that we build a robust institutional framework to support monetary policy in achieving its objectives of ensuring price and monetary stability, which in turn guarantee financial system stability. Considering recent developments within our domestic economy, it is evident that we are facing significant macroeconomic and social challenges. These challenges stem from a variety of factors, including adverse global shocks, unfavorable domestic imbalances, structural rigidities, and the unintended consequences of certain corrective policy measures implemented to restore and realign our macroeconomic landscape. In recent years, the continuous decline in Nigeria's crude oil production has further weakened our already inadequate economic diversification. This has led to a decline in government revenue and foreign exchange inflows, while simultaneously witnessing a growth in public expenditure and a deterioration in macroeconomic indicators, which has constrained our policy options. Consequently, we have seen the fiscal deficit and public debt increase, placing additional strain on external reserves and contributing to exchange rate instability.
We sure hope you enjoyed this video. For more entertaining video content such as behind the scenes of music videos and movies, music concerts, premieres, interviews, and exclusive gists, subscribe now to our YouTube channel GoldmyneTV and be unleashed into a world of super excitement.